Right, well, a very topical question given the election on Tuesday. I think the US is basically a very polarised country. We're looking at the Democrats getting just over 50% of the votes at the presidential election and the Republicans just under 50%. It's basically a split country. The fiscal cliff that you referred to is basically the ending of the tax cuts that George Bush brought in. So basically, there has to be some consensus if we're going to move forward. I think the victory of President Obama, will mean that there will be some movement there. I think the actual electoral college votes were more in favour of him than expected. I think that will give him some momentum to able to put forward some new tax cuts. The importance of this is that if there isn't new tax cuts being put forward, basically there will be a fiscal contraction in the US from the 1st of January. Basically, the US economy can't deal with that, nor can the global economy. So I think there will be some consensus reached in the aftermath of this election. But going forward, I think the US is a very polarised country and there will be ongoing tensions between the two parties for the foreseeable future. Again, another very topical question in that we've just had a vote in the Greek Parliament that has narrowly passed approval for the austerity programme. So that's going to go ahead. It looks as if Greece is going to get the money that they want. Unfortunately, the situation in Greece is one where its ongoing austerity is actually counterproductive now. So at Royal London Asset Management, actually, we believe ultimately that Greece will leave the euro. So I think what we're looking at is sticking plasters at the present time. This is not a long-term solution. Widening your question a bit further, looking at perhaps Spain and Italy, we look at Spain and Italy. Actually, their bond yields have actually behaved very well recently. We're looking at Spanish government bond yields of about 5.75%, and Italian government bond yields of less than 5%. Unfortunately, again, I think this is a temporary lull. We have not addressed the major issues, and that is one of, in effect, the indebtedness in these economies, particularly in Spain, and how austerity can address that. So actually, I do think we're going to have ongoing problems. Clearly, the ECB have taken steps to provide liquidity into the financial system. That is helping. But at the very basic level, we are still looking at tensions within Europe, and they will bubble to the surface, I believe, again in 2013. Basically, our view is that credit bonds relative to government bonds are a cheap asset. We're not actually very optimistic about global growth going forward, and we think we're in actually a period of relatively low government bond yields. But actually the lows that we saw in government bond yields, we take the UK mid this year at 1.4%, I think that's basically too low, and that over a period of time, government bond yields will rise. So I'm looking at a situation in which government bond yields are rising, but credit spreads, the premium over government bonds, are actually attractive. So what we're offering our clients at Royal London Asset Management with the Duration Hedge Fund is an opportunity to participate in credit bonds, but by taking out some of that interest rate risk embedded within government bonds. So it's a very simple portfolio. It embeds our best ideas in credit bonds, and we put in place 5 straightforward interest rate swaps to reduce the interest rate sensitivity of the portfolio. I think it will be really attractive in the environment we see over the next few years. If we look at the valuation of credit bonds relative to government bonds, actually we've had quite a lot of volatility over the last 5 years. If we go back to 2006, prior to the financial crisis, credit bonds had a very stable relationship with government bonds. That actually broke down in 2007, 2008, and credit bonds became very cheap. The premium over government bonds increased substantially. From 2009 onwards, that premium has eroded. We've had periods in which it's increased again because of the euro crisis, but generally it's been on a downward trend. And you're quite right to point out that in the last quarter, and in fact even through the whole of 2012 generally, there has been a reappraisal of credit bonds, and investors are wanting to put money into those assets because they have a yield premium over government bonds. But at the heart of your question, I think, is more fundamentally, do credit bonds actually offer lower risk than government bonds? Because actually when we're investing in credit bonds, we're investing in some very big global companies whose actual balance sheets look very favourable compared with sovereigns at the present time. So I think there is a reappraisal of the underlying credit risks that the big global companies actually have. Now, in Royal London Asset Management's eyes, credit is a cheap asset relative to government bonds. Not as cheap as it was 12 months ago, but still a cheap asset. And I think that will continue over the next 12 months, i.e., I think that credit spread will decline. Investors will put more money into credit bonds because of that extra yield that you can achieve. And after all, when you're investing in investment grade bonds, you're investing in an asset class that historically has a pretty low level of default. And that's the event that you want to avoid in credit markets. You want to avoid that default risk. You're quite happy to take the excess yield. Let's keep those defaults low. So I think going forward, the dynamics of corporate balance sheets at the moment are actually quite attractive. Cash flows are strong, debt is being repaid. And actually I think that is a background in which credit bonds will continue to perform well. Again, a topical question, because recently we've seen the UK have a third quarter GDP of 1%, which sounds fantastic, but actually it has to be seen against the negative outcomes in quarter one and quarter two. Now the Olympics and the Jubilee have had an impact on that. So actually if you take the period together, the UK is actually experiencing a very, very sluggish period of economic growth. Unfortunately, I don't think that's going to change. I think we're looking at a period over 2013, 2014, even out to 2017, 2018, where the austerity programs will have to be implemented to reduce our deficit and the stock of debt that the UK has. So basically, what we're saying is the growth that we experienced in the 2000s was artificial. It was borrowed from future years and future generations. And unfortunately, it's payback time now. And for people now looking for jobs, looking to grow their wages, it's actually a very, very tough environment. I think we just have to get used to a low interest rate, low growth, relatively low inflation environment. For a lot of people, this will feel like a semi-permanent recession for the next 3 to 5 years.